Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the financial world and uncover the real stories behind the numbers. Today we're dissecting Global Payments Incorporated's latest annual report, the big one, the 10K, and let me tell you, it is packed with some serious moves. This report covers the year ending the 31st of December 2025 and gives us a crystal clear look at how this payments giant is navigating the ever-changing financial landscape, most importantly its massive acquisition of Worldpay and the sale of its issuer solutions business. Now let's get straight to the financials because that is where the real story unfolds. The market value of the company's common stock held by people who are not considered insiders was a staggering $19.3 billion as of the last business day of the second fiscal quarter. And remember, it is not just about how big the company is on paper, it is also about how it performs. The number of shares they had out there for everyone to trade on the 10th of February 2026 was 279.9 million shares, a number that directly impacts how earnings per S-Hair are calculated. Let's look at the top line. The revenues for the year ending the 31st of December 2025 Global Payments brought in $7.7 billion. That is almost the same as the $7.73 billion they made in 2024. Now you might think a flat revenue is not great, but considering they sold off two pieces of their business, the advanced MD and payroll solutions businesses, this flat line is actually a sign of strength. It means their core business, the merchant solutions part, is still churning out money. And within that merchant solutions, segment operating income and margin for 2025 actually went up compared to the previous year. Why? Well, they've been working hard on cutting costs as part of their transformation program, that is their fancy word for a major overhaul. This shows they can still boost profitability even without selling more. However, when we look at the overall picture, consolidated operating income tells a slightly different story. It dropped to $1.75 billion in 2025 from $1.97 billion in 2024. This dip is largely due to increased costs for that transformation program and getting ready for the big Worldpay integration. Think of it as investing a lot of money now to make even more money later. The consolidated operating income itself for 2025 was $1.75 billion, a decrease from $1.97 billion in 2024. This means the operating margin also dipped to 22.8% from 25.5%. Those transformation costs are hitting the bottom line in the short term. To be very clear, these transformation costs alone added up to a massive $737.5 million in 2025, nearly doubling from $308.5 million in 2024. That is a huge chunk of change. Now let us talk about debt and expenses. Interest and other expense went up to $649.6 million in 2025, from $602.9 million in 2024. This increase is primarily due to more money borrowed, which makes sense given all the acquisitions and transformations happening. When we look at earnings per S-Hair for continuing operations, that is after you take out the stuff they sold off, diluted earnings, per S-Hair decreased to $4.43 in 2025 from $5.04 in 2024. This is a direct reflection of those higher costs and lower net income. But here is where it gets interesting. The issuer solutions business, that part they sold off, actually saw its revenues grow to $2.5 billion in 2025 from $2.39 billion in 2024. That is a 4.9% increase in a business they were getting rid of. Meanwhile, their merchant solutions business revenues were flat. This really highlights the strategic decision to focus on merchant solutions given how it is evolving. The operating income for this discontinued issuer solutions business soared to $696.6 million in 2025 from $359.1 million in 2024. That is a huge jump, a 94% increase. This impressive performance from the divested business makes you wonder if selling it was truly the right call for immediate profit. But strategically, shedding it simplifies the company. Let us touch upon risks. Their allowance for credit losses on accounts receivable jumped from $24 million in 2024 to $50.2 million in 2025. That is a 109% increase. This means they are setting aside much more money to cover potential defaults from customers. A clear sign they are anticipating tougher economic times, or perhaps seeing early signs of strain in some of their client segments. And then there are the risks. They are upfront about the constant threat of cybersecurity attacks and technological failures. They explain they have multiple layers of defense and a whole program dedicated to this. But they also admit that despite all these efforts, there is no guarantee they can fully prevent these breaches. This is a huge risk for any company dealing with sensitive financial data. Let us talk about the debt. Global Payments has a mountain of debt totaling $19.5 billion excluding the short-term stuff. They are constantly taking on new loans and paying off old ones. This massive debt load can limit their ability to invest in new things or react to market changes, and it means a big chunk of their earnings go just to pay interest. Now, about the big Worldpay deal, they acquired Worldpay in January 2026. This report is from the end of 2025, so it was something that was on the horizon. The acquisition was humongous, costing them about $6.2 billion in cash plus stock, and they also divested their issuer solutions business at the same time. Integrating two massive companies, especially when you are also selling off a part of your business simultaneously, is incredibly complex. They are worried about not being able to combine everything smoothly and not getting all the benefits they expect. This is a classic risk with any major acquisition. Looking at their debt structure separately, they issued $2 billion in convertible notes in February 2024. These notes can be turned into company stock. This is a way to raise money without immediate repayment, but it also adds complexity and potential dilution down the road if those notes are converted. Digging into the financials, the numbers from the balance sheet show total assets jumped to $53.3 billion in 2025 from $46.8 billion in 2024. This massive increase is clearly driven by that upcoming Worldpay acquisition and the associated debt they took on. Liabilities also surged to $29.5 billion, up from $23.8 billion. They are clearly leveraging up to grow. Overall, the company's revenues in 2025 stayed pretty much the same at $7.7 billion. That seems steady, but when you factor in selling off businesses and getting ready for a giant acquisition, it tells a different story of strategic shifts rather than organic pure growth. And how did they perform net income wise for 2025? Net income attributable to Global Payments was $1.4 billion. That is down from $1.57 billion in 2024. Again, this is not surprising given the huge transformation costs the company is absorbing. But for a company this size, $1.4 billion in profit is still very solid. On their balance sheet, goodwill is king. It stands at an eye-watering $17.1 billion. This is the premium they paid over the fair value of net identifiable assets in previous acquisitions. It shows that their growth strategy has heavily relied on buying other companies. The really important thing here is that goodwill can be devalued or impaired if the acquired businesses do not perform as expected, leading to a big hit to their earnings. They did record a $33.2 million goodwill impairment in 2025. So what is the overall story here? Global Payments is in the middle of a huge transformation. They are shedding less profitable or none. Core businesses like issuer solutions and doubling down on their merchant solutions business. The Worldpay acquisition is clearly their biggest bet to become a powerhouse in payments globally. They are taking on a lot of debt and incurring significant costs for this transformation, but the upside, if they pull it off, could be massive. The increased allowance for credit losses is a red flag, a caution sign about the broader economy. They are also playing a constant game of defense against cyber threats. It is a high-stakes game of growth through acquisition and integration, which always comes with its own set of risks. They are betting big on the future of digital payments, and by acquiring Worldpay, they are betting even bigger. The question is, can they successfully integrate Worldpay into their existing operations without stumbling, and can they manage all that debt? It is a bold move, and the next few years will be critical to see if this gamble pays off. What do you think about Global Payments strategy and all this debt? Let me know in the comments. If you found this breakdown helpful, give this video a like and subscribe to Corporate Decoder for more deep dives into company filings and that bonus content and community discussions. We have a Discord server linked in the description below. Thanks for watching, and we will see you in the next one.